If you are just starting to invest, you've probably hit a wall trying to figure out where to put your money. You find yourself caught in an endless debate. Should you choose an SIP, a mutual fund, or just buy stocks? The problem is, this entire debate is built on a misunderstanding. You are comparing things that don't belong in the same category. This chart shows how people view their choices, but we must break it. SIP is an execution method, not a product. It doesn't belong alongside mutual funds or stocks. Think of SIP as the behavioral engine funneling money into actual vehicles, like funds or shares. Mixing up the method with the vehicle won't bankrupt you today, but it will cause long-term pain. You'll end up paying fees you don't need to, or taking on a massive research burden that eventually makes you quit. To build a system that actually works, we need to match your specific timeline, budget, and expertise to the right vehicle. An investment product is the actual asset that holds your money's value. Buying one requires specific infrastructure, like signing up with an asset management company or opening a demat account. An investment method, on the other hand, simply defines how and when your money enters that product. When you confuse the two, you create a psychological roadblock. It feels too complicated, so you freeze, keep your money in a savings account, and lose out to inflation. We need to strip away that semantic confusion. Once we separate how you buy from what you buy, we can engineer a customized, automated wealth-building system. Let's look at the products, starting with mutual funds. These are the default starting point if you earn a salary but have zero free time. The requirement here is simple. You pool your money together with other investors through an asset management company or a standard investing app. In return, you get instant market diversification. A professional handles the portfolio, meaning you never have to read a balance sheet or research individual companies. This chart shows the exact trade-off you are making. Mutual funds sit cleanly in the lowest effort, lowest control quadrant. You give up the ability to pick individual shares, and you pay a higher expense ratio to the manager. For a beginner, paying that management fee is a highly strategic choice. It acts as a guardrail, preventing you from making uneducated, emotional trades with your life savings. If you are comfortable with the basics and want to aggressively cut down overhead costs, your next option is the Exchange-Traded Fund, or ETF. To use this vehicle, you need to open a demat account. This allows you to buy an index fund directly on the stock exchange, exactly like you would buy a regular share. This comparison shows why investors choose ETFs. Because they track an index instead of using active management, expense ratios drop to fractions of a percent, saving you significant money over a few decades while maintaining market diversification. The trade-off is that you accept average market returns rather than trying to beat the index, and you have to handle a slightly more complex technical setup yourself. Returning to our chart, ETFs land in the medium-effort, low-control sector. If you are willing to clear a few minor administrative hurdles to keep more of your compound interest, ETFs are the perfect middle ground. The final vehicle is direct stocks. This is the strict domain of the active controller, who has high financial literacy. Here, your inputs are severe. You use your demat account to buy individual shares, which means you are entirely responsible for researching corporate balance sheets and independently managing your holdings. Doing this successfully gives you total command over your portfolio and unlocks the mathematical potential for maximum wealth generation. Look at the chart one last time. Direct stocks demand the highest effort and grant the highest control. But if a specific company fails, you risk total capital loss. Pursuing those maximum returns requires hours of ongoing analysis. It is essentially a demanding, part-time job, making it a terrible fit if you are already short on time. Now that we know what to buy, let's look at how to buy it. This brings us back to the systematic investment plan. Setting up an SIP means you automate a fixed monthly deduction, regardless of whether the market is booming or crashing. This graph illustrates the mathematical benefit, rupee cost averaging. Over a long horizon, buying consistently smooths out severe volatility. Look at these low points. When markets crash, systematic methods automatically force you to buy more units at cheaper prices. You never have to guess when to enter, removing the anxiety of market timing. You do trade away the potential for explosive short-term gains that could come if you manage to drop a massive lump sum investment at the absolute bottom. But perfect timing is nearly impossible. The real value of an SIP isn't about mathematically maximizing your yield. It is about manufacturing behavioral discipline to survive market fluctuations without panicking. Let's bring this together. This flowchart maps your constraints to the vehicles we've covered. If you earn a salary, lack market knowledge, and have little free time, you follow the time-poor beginner path. Your destination, an auto-pay SIP attached to a mutual fund. You pay a slightly higher fee, but gain absolute peace of mind and enforced automation. If you understand the basics and hate unnecessary fees, you follow the cost-conscious optimizer path. Your destination is a demat account paired with ETFs. You spend time on minor technical setup upfront, securing greater long-term compound savings. Finally, if you have high risk tolerance and deep financial literacy, you take the active controller path toward direct stocks. This path requires skipping pooled funds entirely so you can actively manage corporate equity. Influencers might push complex strategies, but adopting a system you lack time to manage guarantees failure. Before opening any brokerage app, sit down and conduct an honest assessment of how many free hours you actually have each week. Then select just one of these 3 pathways today. Once chosen, commit to it without changing a single variable for a minimum of 1 year. Over a 10-year horizon, maintaining absolute consistency in your execution method matters far more than finding the perfectly optimized fund today. Sustainable wealth isn't built by chasing hot stock tips. It comes from marrying an unbreakable investment method to a vehicle that respects your reality. We like to think that holding cash in a savings account is the ultimate safe move. But the objective reality is uninvested money is literally shrinking. Every single year, inflation acts like rust, eating away at your purchasing power. The obvious escape hatch is the stock market, but picking individual stocks means taking on extreme volatility and dedicating hours to research. It requires a massive appetite for risk that most of us simply do not have. If you have a full-time job, you do not have the bandwidth to tear through quarterly earnings reports or panic over the daily news cycle. You need your money to work, but you cannot make managing it a second career. This is where the mutual fund comes in. It serves as the middle path. Instead of buying individual stocks yourself, you pool your capital with thousands of other investors into a single vehicle. But here's the catch: accessibility does not equal safety. If you choose the wrong type of fund for your specific timeline, you could either expose yourself to disastrous short-term losses or cripple your growth over the long haul. Participating in the market isn't optional if you want to build wealth, but the specific vehicle you climb into determines whether you actually survive the ride. When you buy a mutual fund, you hand that pooled money to a professional fund manager. Their job is to take that massive pile of capital and purchase a wide basket of different assets. That basket creates diversification. If one company in the pile goes bankrupt, it barely makes a dent in your overall portfolio because the risk is spread out across hundreds of other positions. But look at this diagram to understand the core trade-off. That professional management isn't free. You pay an expense ratio, a guaranteed premium taken as a slice right off the top of your total returns. And the fund manager gets paid whether they actually make you money or lose it. Watch what happens mathematically over 20 years. A 1 or 2% fee sounds tiny up front, but over decades, that removed slice compounds into a massive drag on your wealth. You are giving up a significant chunk of your final net worth. A mutual fund is a transaction. You are buying psychological ease and outsourcing your risk management, and you pay for that luxury with a permanent cut of your absolute returns. To actually make this system work, you rely on the behavioral engine of mutual funds, the SIP, or Systematic Investment Plan. This diagram illustrates exactly how it functions. An SIP forces financial discipline by automatically deploying a fixed amount of your cash into the market every single month, like clockwork, completely ignoring whether the market is up or down. But notice the vulnerability. The entire mechanism assumes you have highly reliable cash flow. If you lose your job and that monthly drop fails, the system stalls out. You are actively locking up a portion of your liquid cash every month. When you combine this rigid automated input with a manager handling the actual buying and selling, the time-poor dilemma disappears. You do not have to log in, you do not have to research, and you do not have to pull the trigger. The true value of an SIP has nothing to do with timing the market. It is a structural barrier designed to prevent you from making emotional, panic-driven decisions with your own money. If your goal is aggressive, long-term wealth compounding, your primary tool is the equity fund, which buys shares of actual companies. Look closely at this graph. Equity funds carry extreme market risk. The multi-year trend slopes upward, but you have to survive terrifying, violent 20% drops along the way to get there. To capture that growth differently, you can use an index fund. This is a purely passive alternative. Instead of a manager picking winning stocks, the fund simply copies a major market benchmark, like Nifty or Sensex. As you can see, the index fund tracks the exact same jagged path. But because you fired the highly paid human manager, your expense ratio drops to near zero. Over time, keeping those fees pushes your final endpoint noticeably higher. But an autopilot cannot swerve. When the market crashes, the index fund rides the market straight down to the bottom. An active manager, however, can quickly pivot to defensive assets, creating a slight cushion for your fall. Choosing between active equity and passive index funds is a wager. You have to decide if a human manager's crisis intervention during a crash is worth paying 20 straight years of guaranteed fees. If you cannot stomach that kind of volatility, the direct alternative is a debt fund, investing your money in government bonds and fixed income assets. These funds are not built for explosive growth. Their entire utility is strict capital preservation, offering you steady, highly predictable yields. Check this comparison to see the reality. Debt fund returns are incredibly low. Your yield barely clears the baseline inflation rate, leaving you with a razor-thin margin of actual profit. If you want something in between, you look at hybrid funds. These are intentional compromise vehicles, mixing a portion of high-risk equity with a stable base of debt. Notice where it sits on the chart. You intentionally sacrifice the wealth-building peaks of a pure equity bull market. In exchange, you guarantee a much smoother, less panic-inducing ride when the market inevitably dips. In the financial markets, safety is the single most expensive commodity you can buy, and you always pay for it directly with your upside potential. This brings us to the final evaluation. Choosing the right fund does not depend on how much risk you think you can handle. As this flowchart shows, it relies entirely on answering one precise question. When exactly do I need to spend this money? If you need that cash in less than 3 years, for a house down payment or tuition, it must go into debt funds. You cannot afford to have a sudden market crash wipe out your principal right before you need to spend it. If your timeline is 3 to 7 years, you take the middle path. Hybrid funds offer the moderate growth you need to outpace inflation, alongside enough downside padding to survive a mid-cycle correction. But money you will not touch for 7 years or more belongs in equity or index funds. You have enough time on your side to ride out any major market crashes and let the math of compound growth do its job. Putting money you need next year into an aggressive equity fund is not investing. It is a critical structural error that practically guarantees failure when the market turns. If you are a time-poor optimizer, your path is straightforward. You pair a low-cost index fund with an automated monthly SIP to capture market returns with zero daily effort. If your goal is capital preservation, use debt funds exclusively. Treat them as an inflation-shielded vault to park your emergency funds or protect cash for an impending major purchase. But look at the trade-off on screen. You must avoid mutual funds entirely if you demand granular control over every single asset in your portfolio, or if you refuse to pay management fees. You cannot have absolute control and automated distance at the same time. Mutual funds do not generate free money. They are mechanical tools designed specifically to put distance between your wealth and your own worst behavioral instincts. A true financial edge does not come from picking the perfect stock. Instead, it comes from choosing the specific system you can actually stick with for 20 years, without panicking.
निवेश की दुनिया में एक शब्द है जो आजकल हर जगह सुनाई देता है, ETF, यानी एक्सचेंज ट्रेडेड फंड। अब ये नाम सुनने में थोड़ा भारी भरकम लगता है ना, पर असल में ये है बहुत ही सिंपल। तो चलिए आज इसी ETF की पहेली को सुलझाते हैं और इसे बिल्कुल आसान भाषा में समझते हैं। तो सवाल बिल्कुल सीधा है, ये ETF आखिर है क्या चीज़? देखिए, ETF को समझने का सबसे अच्छा तरीका है उसके नाम को ही तोड़कर देखना। इसके नाम में ही इसका पूरा राज छुपा हुआ है। एक बहुत ही सिंपल सा फॉर्मूला है और अगर वो समझ आ गया तो समझिए सब कुछ क्रिस्टल क्लियर हो गया। तो ये रहा वो मैजिक फॉर्मूला। ईटीएफ कुछ नहीं, बस एक फंड और एक शेयर का मिक्स है। जी हाँ, बस इतना ही, फंड प्लस शेयर। इस एक लाइन को याद रख लीजिए, ईटीएफ का पूरा कॉन्सेप्ट इसी पर टिका हुआ है। अच्छा, अब आप सोचेंगे कि ये कहाँ देखने को मिलता है। तो देखिए, निफ्टी ईटीएफ, गोल्ड ईटीएफ, बैंक ईटीएफ, ये नाम तो जरूर सुने होंगे। ये सब क्या है? ये सब इसी फंड प्लस शेयर वाले आइडिया पर ही तो काम करते हैं। हर ईटीएफ किसी न किसी बाजार को फॉलो करता है। तो अब ये समझते हैं कि ये फंड और शेयर का मिक्स होने का आखिर मतलब क्या है। मतलब इसमें दोनों की अच्छी बातें कैसे एक साथ आ जाती हैं, यही तो इसकी सबसे खास बात है। जरा सोचिए, एक तरफ तो ये एक म्यूचुअल फंड जैसा है। क्यों? क्योंकि इसमें एक ही यूनिट में बहुत सारे शेयर्स या एसेट्स होते हैं, तो डाइवर्सिफिकेशन तो अपने आप हो गया, रिस्क बढ़ गया। और दूसरी तरफ ये बिल्कुल एक शेयर जैसा है, मतलब इसे स्टॉक मार्केट पर लाइव जब मन चाहे खरीदो बेचो, है ना कमाल की चीज। और यही वो पॉइंट है जो इसे ट्रेडिशनल म्यूचुअल फंड से एकदम अलग खड़ा कर देता है। म्यूचुअल फंड की कीमत दिन में सिर्फ एक बार तय होती है, वो भी मार्केट बंद होने के बाद। लेकिन ईटीएफ, अरे ये तो शेयर की तरह है। सुबह 9:15 से 3:30 बजे तक मार्केट में इसका भाव ऊपर नीचे होता रहता है। आप रियल टाइम में ट्रेड कर सकते हैं। ठीक है, अब ये तो समझ आ गया कि ईटीएफ क्या है, पर सवाल ये है कि इसमें पैसा क्यों लगाएं? मतलब इसके फायदे क्या क्या हैं? चलिए अब इस पर बात करते हैं। देखिए, मोटे तौर पर 4 बड़े फायदे हैं। पहला, खर्चा यानी एक्सपेंस रेशो बहुत ही कम होता है, जिससे आपके रिटर्न पर ज्यादा असर नहीं पड़ता। दूसरा, एक ही तीर से कई निशाने, मतलब एक इन्वेस्टमेंट में ही डाइवर्सिफिकेशन मिल जाता है। तीसरा, फ्लेक्सिबिलिटी, जब मर्जी खरीदो जब मर्जी बेचो, बिल्कुल शेयर की तरह। और चौथा, ये किसी इंडेक्स को कॉपी करता है, तो परफॉर्मेंस ट्रैक करना बहुत आसान हो जाता है। लेकिन जैसा कहते हैं ना, हर सिक्के के दो पहलू होते हैं, तो फायदों के साथ साथ कुछ ऐसी बातें भी हैं जिनका ध्यान रखना जरूरी है। एक बैलेंस्ड व्यू रखना इंपॉर्टेंट है। सबसे पहली चीज, इसके लिए एक डीमैट अकाउंट चाहिए ही चाहिए, जैसे शेयर रखने के लिए होता है ना, बिल्कुल वैसा। दूसरी बात, जो लोग बाजार में नए हैं उन्हें ये थोड़ा टेक्निकल लग सकता है। और तीसरी, कभी-कभी कुछ खास ईटीएफ्स में लिक्विडिटी, मतलब खरीदार और बेचने वालों की कमी हो सकती है। इससे सही दाम पर सौदा करना मुश्किल हो सकता है। तो कुल मिलाके कहानी क्या है? कहानी ये है कि ईटीएफ आपको एक ही इन्वेस्टमेंट में डाइवर्सिफिकेशन की सेफ्टी और शेयर ट्रेडिंग की स्पीड दोनों देता है। ये फंड की दुनिया का बेस्ट पार्ट और शेयर की दुनिया का बेस्ट पार्ट एक साथ एक ही पैकेज में लाता है। तो अब इस सारी जानकारी के बाद एक सवाल तो बनता है, क्या आज के दौर के निवेशक के लिए ईटीएफ ही सबसे सही रास्ता है? खैर, इसका जवाब किसी एक के पास नहीं है। ये तो हर निवेशक की अपनी ज़रूरत, अपने गोल्स और रिस्क लेने की क्षमता पर डिपेंड करता है।
चलिए, इंडियन इक्विटी मार्केट में इन्वेस्टिंग को एकदम आसान भाषा में समझते हैं।
स्टॉक्स, म्यूचुअल फंड्स, ईटीएफ, शुरुआत कहाँ से करें? ये कन्फ्यूजन बहुत कॉमन है।
सिंपल भाषा में ये किसी कंपनी में हिस्सेदारी है, जैसे रिलायंस या इन्फोसिस का एक छोटा सा हिस्सा। डायरेक्ट स्टॉक्स में इन्वेस्ट करना मतलब हाई रिस्क और हाई रिटर्न का खेल। बड़ा फायदा हो सकता है तो नुकसान भी। अब जरा इस टेबल पर नजर डालते हैं, कौन सा ऑप्शन बिगिनर्स के लिए है और किसमें ज्यादा रिसर्च लगती है। जो लोग अभी शुरुआत कर रहे हैं उनके लिए बेस्ट है इंडेक्स म्यूचुअल फंड में एसआईपी। एकदम सिंपल। अगर कम कॉस्ट में इन्वेस्ट करना है तो एक्सचेंज ट्रेडेड फंड्स यानी ईटीएफ्स एक स्मार्ट चॉइस है। जिनकी मंथली सैलरी आती है उनके लिए एसआईपी एक कमाल का टूल है। ये इन्वेस्टिंग को आदत बना देता है। और अगर स्टॉक रिसर्च में महारत हासिल है तो ही डायरेक्ट स्टॉक्स की तरफ देखना चाहिए। तो अगर हर महीने सिर्फ 5,000 रुपए इन्वेस्ट करने हो तो देखते हैं इसे कैसे बांटा जा सकता है। बिगिनर्स के लिए सबसे आसान तरीका, पूरा 5,000 रुपए एक इंडेक्स फंड एसआईपी में डाल दें। थोड़ा सा बैलेंस्ड अप्रोच तो 3,000 रुपए म्यूचुअल फंड में और 2,000 रुपए ईटीएफ में लगा सकते हैं। और जो लोग ज्यादा रिस्क ले सकते हैं वो थोड़ा पैसा डायरेक्ट स्टॉक्स में भी लगा सकते हैं। ये समझना बहुत जरूरी है कि ज्यादा रिटर्न की उम्मीद है तो ज्यादा रिस्क भी लेना पड़ेगा। एक्सपर्ट्स के हिसाब से ज्यादातर लोगों के लिए ये एक बैलेंस्ड लॉन्ग टर्म पोर्टफोलियो हो सकता है। अब कुछ गलतियों की बात करते हैं। पहली, कभी भी किसी की टिप पर स्टॉक मत खरीदिए। दूसरी गलती, शॉर्ट टर्म का पैसा कभी इक्विटी में नहीं लगाना चाहिए, ये लॉन्ग टर्म के लिए है। और तीसरी जरूरी बात, इमरजेंसी फंड बनाए बिना इन्वेस्टिंग शुरू करना एक बड़ी गलती है। और हाँ, चौथी गलती, उधार लेकर इन्वेस्ट करना। ये बहुत ही ज़्यादा रिस्की हो सकता है। चलिए एक बार फिर इन चारों को एक एक लाइन में फटाफट समझ लेते हैं, एकदम सिंपल। तो अब रास्ते तो क्लियर हैं, बस चुनना यह है कि अपनी फाइनेंशियल जर्नी के लिए कौन सा सही है।